I'm Graham Rowan, the Renegade Investor, cutting through the crap to tell you what's really happening in the world of wealth creation and wealth protection. Today's episode is part of the Renegade Investor University series, where I bring you up to speed on a particular type of investing or an asset class that I think you should be in the know about. Today, I want to start with an overview of precious metals and why I believe they need to be an important part of your wealth preservation plan. The starting point is to understand the difference between currency and money. We live in an age of fiat currencies. When I was a lad, they used to say that a fiat was an expensive Italian machine for heating up oil and spreading it all over the road. I don't mean that kind of fiat. What I mean is that our currency, just like the dollar or the euro, has nothing behind it to sustain its value other than the say-so of the government. I promise to pay the bearer on demand the sum of £5. We talk about pound sterling without ever really listening to the words. Sterling is silver. A pound is a unit of weight. So originally, a pound was equivalent to 16 ounces of sterling silver. Today, a single ounce of silver will cost you £18.36. So a pound of silver would require £293.76 to obtain. And that's the crux of the matter. Until 1971, the pound, the dollar, and most other currencies were backed with gold. Every time you printed a batch of pound notes, you had to add some gold to your reserves to back them at an agreed ratio based on $35 per ounce. Think about that for a minute. Think of the discipline that would impose on politicians and central banks. The money supply was a carefully monitored metric, and it could not be increased without buying some assets to back the new notes. Today, this all seems fanciful. The Governor of the Bank of England simply clicks his mouse to create £1 billion new pounds. There's no gold to back them. No assets are added to the UK economy. All he's done is print money to pay bills we can't afford and devalue all the previously existing pound notes in the economy. He's deliberately reduced the purchasing power of your savings. And by combining this wanton expansion of the money supply with below inflation interest rates, he not only robs from savers, but keeps annuity rates low, so retirees are hammered when they convert their pension pots into an income stream. We're in uncharted waters with money printing on this scale. The increase in the money supply mirrors the hockey stick rise in national debt. Just look at it on this chart here. Now, economic theory says we should be experiencing hyperinflation by now. Obviously, we can't believe official government figures on inflation. CPI is really the CP lie. Anything that goes up in price too much being substituted with cheaper products. They even adjust the index down to reflect enhanced utility of products in the basket. So if your next phone has got 20% more features, or your laptop has got 20% more memory, they'll treat that as a 20% price reduction. If you actually study what you're paying for fripperies like electricity and food, you'll find at least 10% inflation is closer to the norm. Add that 10% inflation to the increase in the money supply, and it should be clear that the purchasing power of the pound is going to keep on declining until it gets close to zero. I'm convinced there's a major meltdown coming in the not too distant future, but it's really hard to predict when. It could be 6 months, it could be perhaps more likely 5 or 6 years. It'll probably be triggered by something like the recent Cyprus bailout, which could easily have led to a run on the banks and loss of confidence in the fiat money system. Once confidence is gone, panic sets in and things can start to get really ugly. I'm not talking about the London riots of 2011, that was just plain old-fashioned looting by freeloaders jumping on the bandwagon while the police looked on. I'm talking about real unrest brought on by people who've lost everything. Fanciful? I hope so. Possible? Absolutely. That's why you need to have some level of what I call portfolio insurance, by which I mean some real money rather than fiat money. Which brings us to gold and silver. As the purchasing power of the pound declines, so it takes more and more of them to buy an ounce of gold or silver. So to protect myself from total loss of sterling's value, I put around 10% of my wealth into gold and silver. I do this in two ways. First, through allocated physical bullion held in a secure vault in my name in Zurich. Second, through the purchase of gold and silver coins like these, held in secure storage. These are 99% proof, and because they're regarded as coins of the realm, they're free of capital gains tax when you eventually sell them. There are lots of ways to gain exposure to gold and silver, including through investment trusts, unit trusts, and exchange-traded funds, or ETFs. I can't cover the whole topic today, but I will in future episodes. But briefly, ETFs don't give you any gold or silver that's specifically allocated in your name. If there's a sudden run and everyone wants to sell, will they be able to deliver your metal into the market, or will the transaction be stopped for lack of access to the underlying assets? Many investment trusts invest in gold and silver miners rather than the metals themselves. I think there are some great opportunities here, but this is a very different type of investment to the actual base metals gold and silver. If you'd like to learn more about this kind of investment and learn the source of my own precious metal investment, please go to whybullion.co.uk. Pop your details in the form under the video, and then you'll get full information. The beauty of this asset class is that you can start investing with as little as £100 a month, so it's available to everyone. So once again, that's whybullion.co.uk to learn about how I invest in gold and silver bullion and with whom. Thanks for watching. I'll talk to you again very soon.